This is how the big players manipulate you. We will go deeper into trading with our videos and try to eliminate as many false beliefs as possible. Important. Always question what someone thinks they know about trading. Question us too. Only 5% of Forex traders, 15% of futures traders, and 3% of stock traders are successful in the long term. And this is largely due to the false information that is spread. But who are the big players? In the Forex market, it is the banks. After all, it is their market. However, the situation is different for stocks and futures, where the differences between the big players and retailers are not as extreme as in the Forex market. The biggest influence in stocks and futures are mutual funds, insurance companies, pension funds, and hedge funds. Most traders go through the same process in the beginning. They are taught that indicators like the moving average, RSI, stochastic, and many more indicators as well as trend lines, chart formations, candlestick formations, are the holy grail of trading, the way that will make you a multi-millionaire overnight. And do you know why they learn it? Because all the gurus with their leased Lambos in Dubai themselves don't know what they are talking about, and these are the only things they can explain. Whether it works or not doesn't matter, because they make their money with their useless coaching. The big players have the money to move the market as it suits them. They know most of the strategies of the retailers and where their stops are, so they use their knowledge to create certain formations in the chart. It doesn't have to be a bad intention of the big players, but they need your stops to quickly and unobtrusively build or exit larger positions. They trade with several thousands of lots, so you cannot enter or exit at any time as with the retailers. Another reason is that if everyone speculates on a rising or falling price, the market cannot move, because if someone wants to buy, someone else has to sell and vice versa. How this works in detail we will explain in another video. Now we come to the RSI. The RSI is a lagging indicator that should not be used in general. What do I mean by lagging? Many did not know it. The candle chart is an indicator and indeed the fastest. From the stock exchange or the broker gets the trading software either tick data or open, high, low, closed data. These data are translated by the trading software and the candle chart is formed. The RSI is an indicator that takes the information from the candle chart. That is, it shows you only the outdated data from the candle chart in a different form. The RSI is an indicator that looks good in retrospect, but in live trading you can lose a lot with it. It shows you if the market is overbought or undersold. Now the big players come into play. They know that the masses speculate on a falling price when the RSI is oversold, and on a rising price when the RSI is undersold. The big players move the market so that the RSI indicates that the market is oversold. When the masses have placed their trades, they move the market further up to trigger the retailer's stops. The same game in reverse. Indicators like the moving average, stochastic, super trend, and many others are also lagging. How exactly they work we probably don't need to explain, and we don't want to. Let's move on to candlestick formations. You have surely noticed that you have a different formation in each time unit but why is that? Candles are usually calculated based on time times price. When the time is up, a new candle is created. In principle, it is just a random product. It would be much smarter to use tick-based candles. They are much closer to the truth. Let us know in the comments if you want a video on this. Depending on the broker or data feed provider, there can be variations in the price. Therefore, you will most likely have this pattern with this broker and another on that broker. The big players are the only ones who can move the market, so why should they pay attention to candlestick patterns or chart patterns that they themselves have formed? With chart patterns, we have a similar problem. However, it is easier to manipulate. The big players know most of the formations and form them specially to trigger the stops of the retailers. That was some information. We hope it was easy to understand. If you have any questions or suggestions, please let us know in the comments.